Good morning. Welcome to Investing Analysis. If this is your first investing analysis, welcome. My name is Professor Adam, and every single day I will be taking you through the information and the data that I believe is most relevant to understanding what is going on in the cryptocurrency market. But everything that will be covered through the context of the larger perspective of all of the systems that I've already designed. So if you've come and you haven't done all the lessons yet and you haven't passed the masterclass, you will not likely get the full value out of this stream that you could have. So obviously, my opinion is that you should be passing all the lessons and watching these at the same time, but getting through the masterclass is of critical importance. And I will say the same thing every single day. There is no substitute for comprehensively understanding the activity that you're engaging in. There are no shortcuts. There is no trick. So get the work done or fail miserably. Now let's continue. First things first, medium-term TPI has had a state changed along with a rapid rate of change in the positive direction. As you can see, it is beyond what I would consider the threshold of neutrality to be, which is 1 on either side. It is now beyond that, so I consider that to be a long signal. Now, yesterday you could see that creeping up on Ethereum as well. So I think that this was you could have reasonably predicted this, but it's kind of funny as well that it happened after I covered the liquidity information from yesterday, which of course I told you is quite bullish. It's almost like there's some sort of a fucking, there's ears listening in, and there's like spies from all over the world at big hedge funds and family offices and corporations, and they're all here in the real world campus listening to me. Either that, or it's the smart people looking at the same data that I am, as I would hope they would be in people who are managing large amounts of money. I suppose highlights how fucking good that you have it, that you as plebs can get access to me, who is somebody who's incredibly advanced. Anyway, positive rate of change on long-term TPI as well. Fantastic. That was due to the trend analysis on the liquidity proxy going long as well. And we're continuing to increase in price today, even after the close, which is fantastic. So I won't dwell on that too much longer. I've got a lot of information to go through today. Today's investing analysis is going to be extremely long. We'll start off at the beginning and the best, which is probably the Capital Wars letter. We also have a 42 macro note here as well. Now, basically this, I had a quick scan through it before I started this stream. Basically, this Capital Wars letter is just discussing the future direction of Fed liquidity and the requirement for you to have hedges like gold and Bitcoin in your portfolio, which is something that we already know. But the main opening paragraph here is of critical importance, and it's worthwhile covering again. The article restates our concerns and beliefs. It considers both why global liquidity is important and paradoxically why it is also a hidden danger because it leads to monetary inflation. Monetary inflation is not high street inflation, which you as regular people would understand as the consumer price index or CPI. But alongside cost inflation deflation, there are components. Investors will need more monetary inflation hedges, not CPI hedges. Such things don't really exist. Evidence, the chart below, which shows 3 lines: global liquidity in black, the value of monetary inflation hedges in gold, and US high street prices in the dashed line. Gold and crypto, aka exponential gold, are great monetary inflation hedges, but not necessarily high street inflation hedges. Note, separately, we have shown using statistical techniques that global liquidity Granger causes, i.e. leads Bitcoin from 5 weeks onwards, and it leads gold from 36 weeks onwards. This is an incredibly low resolution image. I don't know how the fuck Michael Howell can get away with uploading images this low resolution, but you can see what we have effectively is gold and Bitcoin, which I believe is an 80-20 mix. An 80-20 mix between gold and Bitcoin in gold here. We have global liquidity in the solid black line along with its projections into the future, which is quite good. I love to see that. And of course, we have cumulative US CPI. Cumulative US CPI. This is not a rate of change measurement, right? Cumulative. So you can see the difference between what you, as even regular people, don't really understand what inflation is. How many normal people truly understand what inflation is? Probably fucking none of them, right? And of them, of the people that do understand what CPI is, how many of them understand the difference between consumer price inflation and monetary base inflation, or monetary inflation, however you prefer to fucking call it? The difference between plebs that don't even know what fucking inflation is versus the people that know CPI is. You think that you're superior to everybody else when you're here, when you know what regular CPI is. And yet, of those people, probably the same fraction do not understand the difference between monetary inflation, global liquidity, which is the thing that you need to be hedging anyway. And everybody goes, oh, why are prices going up so much? Why isn't Bitcoin going up when CPI goes up? Bitcoin doesn't hedge CPI. Bitcoin hedges global liquidity. So, if you're faced with a circumstance where global liquidity is slated to increase rapidly over the following years, then what would you purchase? Gold? Probably not if you want to make it. You would purchase something a little bit more, with something a little bit more powerful, wouldn't you? Cryptocurrency. So that forms the foundation of everything that you should understand when looking at the markets and what you need to do in terms of hedging yourself against this stuff, which is the crux of this entire article here. Now, there's a lot of talk about how liquidity works. Now, of course, for anybody, it would be very beneficial to understand this. I'll scroll through this slowly, but I'm not going to read it out to you. If you want to pause this video and read through that yourself, please be my guest. You may find that there's something very interesting and useful in here that you want to check out. But I will fucking come down to the end here, which is the most important part. Now, monetization is happening again now. Evidence both the recent heavy issuance of treasury bills and our future projections of Fed liquidity in the chart below. This uses the baseline numbers from the Bipartisan Congress Budget Office adjusted to allow for more defense spending. A slower engagement of Fed QT policies, and whether or not you agree with the defense spending, I think that maybe it's half of that. In the runoff of the reverse repo facility and the slower engagement of the Fed quantitative tightening policies, the percentage above each bar refer to the predicted annual changes in Fed liquidity. Bottom line is the Fed liquidity is slated to double in size over 5 years. Double in size. Monetary inflation is coming. You must hedge. Now, you can see here the projection for 2024, which is the year we're currently in, is substantially higher than last year, even considering that they decreased. 2025 is not looking so good, but I reckon that the fucking ECB, because they're lagging so far behind the rest of the world, will have to play catch up on that, along with whatever structural issues that China has. I would imagine that there will be less of a dip through here, but then what do I know? Michael Howell probably knows more than me. And this as well is worthwhile thinking about in terms of what your long-term strategy with Bitcoin looks like. This is not really talking now about tactically what you plan on doing with your portfolio over the next 2 years, but into the future. If you take nothing else away from this, then the question that I ask you now is, what is your plan for this part of the future? Now, KYC is coming for your cryptocurrencies, right? Now, you must understand cold storage. Things like MetaMasks will probably not be a thing in the future. Like browser extensions and hot wallets and things like that, they will probably all get hacked into oblivion, or I don't know, maybe they'll all be KYC'd and nobody will use them anymore, or whatever. I don't know, maybe not. But think about into the distant future. What are you going to do with your seed phrases? How are you going to store them so that your seed phrases are protected for 10 years? What type of storage device will you use? Will it be metal? Will you put it in a fucking safety deposit box in Switzerland? I don't know. Think about the natural world and whether or not your seed phrases are earthquake proof, volcano proof, flood proof, chemical proof, crush proof. Whether you can bury it in the fucking in the salty ass sand and have it not corrode into oblivion. Think about what you're doing with your seed phrases into the future. I'm going to be gone here I'll be not fucking here anymore, right? Because I'm going to be a multi-decker millionaire, and I will not, I will have shit to do. I will have a life to live. So you need to think about what your plans for the future are, because I'm not going to be here to hold your hand forever. Such is life. Such is life, right? I'm not your fucking father. I'm not your mother. I'm not your guardian, all right? I'm not going to be here forever. Right, so 42 macro. The US, I haven't read through this yet because there's just so much to do, so I'm just going to do it while I'm recording. The US Treasury and Beijing are likely to continue pursuing investor-friendly policies over the medium term. Wonderful. I hear in her testimony to the House Financial Services Committee, Treasury Secretary Janet Yellen remarked, "I believe the problems facing the commercial real estate sector are manageable, although there may be some institutions that are quite stressed by this problem. The Treasury's willingness to work with affected lenders represents an upside risk to U.S. liquidity," which is excellent, "and by extension, asset prices. Lastly, we see the CSRC shakeup as an incremental sign of Xi's desperation to fix China's broken stock market. Investors should expect more positive global liquidity flows from the Chinese liquidity impulse over the medium term. Yeehaw! Celebrate. Good times." Okay, so on the discretionary investment ideas, we still have a hat trick for Bitcoin, which is max long and bullish on all of those dimensions, which is good. Any changes? No, really crazy to talk about. You could make the argument that over the last 24 hours, the pump in cryptocurrency has probably taken Bitcoin to the top end of its VAMs. That is absolutely possible. Ethereum too. So whatever we have right now, don't get too horny for gains. Like, we may be at a point where we're at the top of the volatility adjusted range, like so. Actually, I think yes. Nope. All right, moving on. Yeah. Yeah. The Treasury's investor-friendly policies are why 42 macro net liquidity has trended high since late 2022. Yeah, good to see. And that will, of course, positively affect cryptocurrencies. Yeah. China liquidity mooning. Good to see. Yeah, rate of change, positive, fantastic, good. Just a random article that I got from SeasonX. I haven't read through it yet, but I'm curious to see what it says about seasonality. US's first ever spot ETF. Yes. Yep. Seasonal chart of Grayscale Bitcoin Trust over the past 8 years shows positive seasonality from March to May. Seasonal chart of MicroStrategy. So if you hold any MicroStrategy, beware, from February to May. Interesting. Okay, now a little bit of new data and maybe a bit of a change into the way that I'm displaying a few things. So we have the Capriol Guardian Exchange Risk Report, which is a way of detecting whether or not an exchange is in trouble or not, whether there is some problems. If there are problems with fucking reserves on an exchange, these are going to start to show up in red, and then the risk status is going to change. So that's actually quite cool. This was developed in the wake of the FTX collapse. So we'll just open that up every single day and have a quick look. Aggregate valuation hasn't really changed much. ETF flows. Now, I might move that down over here somewhere, but ETF flows. Very, very cool website that I was given by one of the students, and I just extracted the daily chart out of this one that updates and shows you what's been happening with the net flows. So you can see here that we have actually above zero. This is one scaled chart. So you can see that the net flows here are positive, and this is taking into account, of course, GBTC outflows as well. So good to see that it's increasing over time. We'll continually check back to this one and see the amazing march upwards as passive flows into the market. Very excited about that. So let's start going through some of the longer term information. You would expect nothing really to change on those ones. I am keeping a very close eye on this. I am wondering whether or not there will be a triggering of this indicator soon, and if that will mean lack of momentum in the future or what. So I don't know. We'll keep an eye on it. No new signals from any of those. Continued decline in the AVIV gradient. Now we are at the Crypto Quant dashboard. I've rearranged a few things, putting the longer term stuff at the top and going to move down progressively into shorter term stuff. And there is no major changes on any of these worth noting. Not really that concerned with any of them. Okay, inter-exchange flow pulse is probably the only one I want to frequently check back in on to see how it's progressing. Again, I'm not very happy with the fact that this is declining at a slower rate, but I would prefer to see that curving up a little bit sooner so that we could get the crossover of that. It still looks to me at the current rate of where the moving average is declining and the potential lag of the inter-exchange flow pulse moving forwards, that we could still have another week of consolidation maybe, but that's just a single metric. The price will do whatever it wants to do. And you saw the value of the LTPI. The value of the LTPI is in a bullish state. So that is and it's an aggregation of many different things. So it's definitely more worthwhile looking at the LTPI than the inter-exchange flow pulse. However, I'm just saying that to try and reconcile the two behaviors, we are bullish for sure. It's just that you may see a little bit more sideways than you would have expected before it resolves upwards to give this time to sort itself out. However, I don't imagine that this indicator would be leading in any state at the moment, since liquidity is the main driver. A short-term holder, SOPR, kind of coming up a little bit. No signal from the binary CVD. New money, no reading. There wouldn't be anything new with the short-term holder, realized profit and loss. NVT Golden Cross, no signal, nothing. Still a volatility warning. That is likely what we saw today and will maybe continue to see highly volatile moves, increasing in volatility until we resolve to the upside to close that liquidity gap that I was covering yesterday in yesterday's investing analysis. And I just added a new one to the list today, binary CDD with a 30-day EMA. It appears as though I'll open it up full screen for you. Now, to me, the high values of this indicator tend to cluster around reversal points. So the question is, what does this one mean? You can see top and bottom. So there was a large cluster there, top and bottom, top, bottom, and then it kind of cruises. And then right now, we have what looks like an incredibly elevated reading at the same type of level that you saw here and here that we're currently at. Now, of course, it's a small sample size. This one only goes back to mid 2021, but I think that this one is actually indicative of a market bottom, like halfway, like through this massive rally that we've had over the last year. I believe that this indication is actually a bottom. I believe that's a bottom at the current values. I genuinely believe that. I know it sounds psychotic to say, but I'm super keen to see how that one resolves itself, because it sounds schizophrenic, but I'm keen for it. I think that might be what it is. Okay, we covered the ETF flows, and I have extracted the Capriol indices from the website, so I don't have to load up the whole website. I just extracted the ones that I wanted so that now I can have them full screen, nice and zoomed in, looks beautiful. So the macro index has not gone back into a bullish state yet, although it looks like it's very close. Ethereum the same, still in slowdown, and I would say it would be very close to turning back positive at some point in the future. Now we have, and this is kind of inconvenient with the pen over here. But yeah, so we've zoomed in a little bit on the speculation index and the breadth index, and you can see those are showing a little bit of strength, probably due to the pump that we received yesterday. And yeah, I mean, generally this one here is the one that I'm most concerned about or most interested in, because you can see how low this reading is compared to the entire price scale that you have. Okay, moving on. Okay, so I've loaded up a couple of the Cane Island models here. I've loaded up all of them actually, and we'll just have a brief look at them. I know I've covered them previously, but I'll cover them again. Just keep an eye on them on a daily basis, obviously accounting for a little bit of alpha decay on these with a reasonable margin of error. We have lowest price forwards trend, which is a regression of the lowest price forwards. We have the Bitcoin adoption curve estimate ACE, which is a derivative of the fucking, what is it? it's the size of the network is still quite low. So you can see the valuation there is very low. What we have the Metcalfe value, which is a little bit rough, but it gives an okay approximation. Then we have the macroeconomic value, and you can see anytime the spread is at a significant level, that is generally indicative of a market peak. Drawdowns, yeah, no major signals from those. No change, no change. Okay, now let's get into some of the shorter term stuff. Holy fuck. Now, this is a very speculative observation. I've never seen that before. Obviously, we don't have any historical precedents for me to analyze this. I'm going to make an assumption because I literally no idea what this means, but I'm going to make an assumption based on nothing other than this characteristic here with Ethereum. That the last time Ethereum had a pump this strong, it actually marked a pre-pump. So I'm wondering if the same thing would be true for Bitcoin, whether an increase in sentiment to this degree is actually a pump warning rather than an overbought signal, because it just behaves so differently to every other sentiment measure. When I'm confused and when I don't believe that there is an accurate way of understanding this, I would rather just hold my judgment back and say I'm not willing to make a call on that, and I'm not entirely sure what's going on. So we're just going to leave that one. Like I mentioned yesterday, good to see active addresses are down. We have what appears to be a little bit of upside liquidation with Bitcoin. Although remember, I've said that's very gentle, very, very, almost no effect. A liquidation level of that height, almost no effect. So don't get panties in a fucking twist if you think that there's going to be some sort of mega moon caused by liquidations. If there's going to be a moon, it's going to be spot driven. I highly doubt that it would be derivatives driven. So of course, now that the market is pumped, everybody and their dogs will be longing on leverage. Of course, especially if the Quiver Quant sentiment is anything to go by, which the liquidation maps kind of verify that. Looks like Solana could go up to 102.6 today. Let's go to the 1 minute chart. Beautiful. Oh yeah. Just kidding. Okay. Yeah. Yeah. Okay. So yeah, after a pump like this, the maps usually look like shit. There doesn't really seem to be anything in there that I can extract. Okay. There's some issues with that website. A little bit of breadth divergence there. Makes me a little bit concerned. Okay, no worries. All right, so there was a request from one of the students, Stagey, actually, who wanted me to do a sneaky review on this one here, the Socrates Skywatcher. I think he said that it is similar to the 42 macro weather model, and that was the kind of behavior that he was going for with this one. And we're looking at Bitcoin, Solana, Ethereum, S&P 500, and DXY. So I'll have a look at those and I'll use those things. So we're at the end of the investing analysis now. This is what I would consider to be a bonus. So, all right, 2 weeks with the default settings. Yep. Yeah, I mean, it's reasonable for a high time frame model. I would say that this is still, that entry there is a little bit late, but it is what it is. What else? Solana, 10 days. Yeah, nice. Yeah, cool. Yeah, good. Sure. Looks nice. ETH 1118. $5 open, cool. All right. Yeah. Yeah. SPX 2 weeks. 24. See, the problem with a lot of this is that it's not really protecting you on the way up. I mean, it looks like it's doing all right historically, but you are avoiding some major declines, but it's like with this one, for example, and or any of these, you end up selling maybe half your position on this bar here, but that was probably a nuke. So you end up maybe getting a value closer to the close here, which is quite significantly below where you were there. And you don't really rebuy until a lot higher, and you don't fully rebuy until higher still. So you don't really end up being protected that much. You're kind of getting fucked over a little bit. You not only don't get out early, but you also kind of like have a loss there, a lot missed opportunity cost. And maybe it's better than nothing. But I have seen systems that are a bit better, and this one here as well. Like during the COVID crash, if you were to try and get out on this yellow phase there, I mean, you're probably getting out lower than what the average of this bar is, which would be like closer to down here probably. And at that point, you've already lost, months worth of gains. It's the reason why peak forecasting is important. Now through here, it would have been fairly useful, I suppose, because the only false positive was there, which is acceptable within reason. But you also knew, if you were using liquidity as a measure, that probably somewhere down here there was going to be a positive inflection in liquidity if you were following Capital Wars. So it's all right from what I understand, and it's all right for managing your positions, I suppose. Oops. All right. Yeah, it's all right. It's better than nothing, I suppose. Cool. All right. All right, thanks for your time, everybody. See you tomorrow for another episode of Investing Analysis.